Okay, so you want to buy a Forex broker. Here's the pitch someone already gave you. It's the closest thing to risk-free money in finance. The broker never bets, never picks a side, just takes a small cut every time somebody else trades. Every word of that is true, and it has still bankrupted many companies overnight. In minutes, without the broker ever placing a single trade of its own. You're about to find out how a business can be mathematically incapable of losing and still lose everything. Every day, more than $10 trillion changes hands trading currencies. More than every stock exchange on Earth combined, several times over. Most of that isn't a tourist changing cash at the airport. It's banks, governments, and companies moving money to keep global trade running. And sitting in the middle of that river, taking a small cut every time someone crosses it, is the Forex broker. Here's the part nobody explains properly. A Forex broker is a company that lets ordinary people bet on whether a currency, like the dollar or the euro, is going to go up or down. The obvious guess is that the broker is making the same bet you are. It isn't. Every time you place a trade, there's a tiny gap between the price you buy at and the price you sell at. That gap is called the spread. It's the same trick as a currency exchange booth at the airport. You don't ask if it's a good day for the pound. You just notice the number they quote you is never quite the number on the news. You collect that gap, whether the currency goes up, down, or nowhere at all. But here's what makes this business different from almost anything else. When a client places a trade, you've got two choices. Pass it to a real bank and collect the spread. That's called A book, and you make the same money no matter who wins. Or keep the trade yourself. That's B book. And now you're the one on the other side of it. If your client loses, the money comes to you. And if your client wins, it comes out of your pocket. Here's why that bet favors you. Between 74 and 89% of retail traders lose money, not sometimes. Consistently, year after year, on nearly every platform. Which is exactly why regulators now force brokers to publish that number on their own homepage. Your best customer was never the sharp one with the spreadsheet. It's the one still convinced this is the month he finally figures it out. Most large brokers run both books at once, sorted automatically. The rare client who's actually profitable gets quietly routed to A book. Because you don't want to be on the losing end of someone who knows what they're doing. Everyone else stays in B book, where their losses are your income, and the spread's just the entry point. Leave a trade open overnight, you charge for holding it. Let clients trade with borrowed money, which most of them do, and you charge interest on the borrowed part. A credit card charging interest on a balance nobody paid off. None of this needs the market to move in your favor. All of it gets collected regardless. None of it is free to set up. The license is the first bill, and where you buy it changes everything. Somewhere that doesn't ask many questions, like Seychelles, runs $50,000 to $100,000, but you legally can't advertise to clients in the US, UK, or European Union. Sell in Europe instead, and Cyprus wants up to 750,000 euros in required capital. The UK or Australia wants $500,000 to $1 million, plus up to £500,000 in setup, spread across a year or two of review. And the United States wants $20 million sitting there before you're even allowed to open the doors. That license buys you something specific, a stranger's trust. It's the reason someone deposits $50,000 into a company they've never physically visited. Client funds held separately from your own. Audits, sometimes a fund that pays clients back if you collapse. Which is also why this business isn't as crowded as the profit margins suggest it should be. There are thousands of Forex brokers in the world. Names like Exness, IG, and Pepperstone spent over a decade each clawing their way to the handful you'd actually recognize. The barrier that earns you trust is the same barrier that keeps almost everyone else out. And even once you're through it, the license still isn't your biggest expense. Getting one real person to fund an account and start trading costs $300 to $1,000 in advertising alone. Multiply that by the thousands of clients you'd need to matter, and your first year of marketing can run $500,000 before you've made a cent back. That's why Forex brokers sponsor football clubs and Formula One teams. Not to look impressive. Because a new client is the most expensive thing you'll ever buy. Build from scratch, and you're paying every cost you just heard in full before your first client logs in. Rent a white label under someone else's license, and you're operating within days, but you're a tenant, not an owner. Or take the route almost nobody talks about. In 2026, there's an actual marketplace for buying a Forex broker's license. A fully licensed brokerage in Cyprus, complete with an active client base holding close to $15 million, is listed for sale right now. You're not buying a company. You're buying a company that already has $16 million of someone else's money sitting inside it. And the keys just haven't changed hands yet. Sounds like the deal of the century. But here's the fine print. The regulator still has to approve you personally as the new owner, which can take months on its own. And a license that's cheap to acquire is usually cheap for a reason: a thin client base, a compliance history you're about to inherit. By the time you've fixed both, the discount is the only thing you remember about the deal. None of that stopped a 25-year-old with $200. Meet Owen Kerr. In 2010, he was a computer science graduate in Melbourne with no background running a financial company. Just a hunch that ordinary currency trading was overpriced and badly built. With a partner, Joe Davenport, he started Pepperstone, reportedly letting clients open an account with as little as $200. 4 years in, the company was pulling in $60 million a year. By 2017, revenue had reached $166 million, with $71 million of that as pure profit. A year earlier, Kerr and Davenport sold a majority stake to a private equity firm, cashing out a piece of something they'd built from a spare office into one of the largest Forex brokers in the world. Here's what made that speed possible. Once the license, the platform, and the compliance team are built, your next 100,000 clients cost far less to add than your first 100 did. The expensive part is the foundation. Everything after that is closer to pure margin. The broker can't lose on the trade itself. That doesn't mean the broker can't lose. The whole business depends on currencies moving in small, predictable steps. On January 15, 2015, the Swiss National Bank did the one thing it had promised for over 3 years it would never do. With no warning, it stopped propping up its fixed rate against the euro. The Swiss franc moved up to 41% in value within minutes. The biggest single currency move ever recorded, faster than most people could read a headline about it. FXCM, one of the largest Forex brokers in the world at the time, announced its clients now owed the company $225 million vanished into negative balances overnight. Its stock collapsed, cutting the company's value to roughly $600 million in a single session. It survived only because an outside investor handed it a $300 million emergency loan at 10% interest, just to keep the lights on. Alpari, a major UK broker, didn't survive at all, insolvent the same day. For a few hours that morning, a licensed trading desk at Goldman Sachs and a guy running a white label brokerage out of a spare office had exactly the same amount of information. Zero. Regulators spent the years since capping how much borrowed money brokers can hand retail clients, specifically to stop a repeat of that morning. They're still tightening it. As recently as February 2026, regulators in Europe extended those same restrictions onto crypto trading, because the underlying problem never actually went away. So why do brokers like this still make hundreds of millions a year anyway? Three ways this plays out, and only one of them pays back fast. At the smallest scale, an introducing broker setup costs next to nothing to start. Maybe $25,000 in setup and platform rental. But you're not really running a business. You're earning a commission check every time someone you referred places a trade. And that check is only ever as big as the traders you can personally keep active. At the middle tier, a fully regulated broker at Pepperstone scale, alongside names like IC Markets and Oanda, costs somewhere between $500,000 and $2 million to properly license. Once it's running, realistic revenue lands close to $100 million a year. Strip out staff, compliance, liquidity costs, and client acquisition, and net profit tends to land somewhere between a third and half of that. Real money. But the first year or two is almost entirely spend, not income, while the license clears and a client base builds. Payback on the initial investment 2 to 4 years if the trading volume shows up on schedule. At the top, a broker at IG Group's scale generates over £1 billion a year, with roughly half of that surviving as profit after costs. But nobody starts there. Getting there took decades of regulatory trust, enough capital reserves to survive a shock event without going under, and enough scale that a bad quarter doesn't sink the company. In the good case, you clear the break-even point years before a black swan currency event ever finds you, and by the time it does, your reserves absorb it. In the bad case, you're Alpari, insolvent the same day the market turns on you, because the growth outran the safety net. The gap between those three numbers was never really about effort. It was about how much trust you could buy, how many clients you could keep trading long enough to matter, and whether you were still standing the one morning a central bank decided to break its own promise. Risk-free was never a lie. It just turned out mathematics couldn't predict one Thursday morning.